Mass marketing and the consumer culture have, over a few generations now, subconsciously programmed Americans to equate happiness with spending money and acquiring stuff. Hey, MCE crew, Madison Avenue, that whole advertising and marketing infrastructure here in America, man, these guys are extremely intelligent. What they've done is they have committed themselves for a long time now to understand how the human brain works and how neurotransmitters in your brain, like dopamine and serotonin and cortisol, how they work in order to manipulate your mind into becoming a conspicuous consumer and feeling good about it, as opposed to doing what's in your financial best interest and acquiring assets. Now, you've got folk like Peter Thiel, Elon Musk, Jeff Bezos, myself. I have always been someone who got a dopamine hit, one of those feel good chemicals that the brain releases. I've always gotten a dopamine hit when I've been able to invest money. Okay? The inverse is true for a large part of society. And look, this is generational. This started way back when the Dixie Cup Company figured out that they had to convince you that that bathroom cup that four family members shared prior to the invention of the Dixie Cup, that was, oh man, that was going to kill you and all of your family, even though it never had. You needed these disposable cups that you had to purchase every so often, giving money to the Dixie Cup Company in order to be healthy. And if someone came over to your house and saw the bathroom cup as opposed to the disposable Dixie cup dispenser, then you were just not doing it, man. You were a part of, some throwback generation that didn't care about health. Okay, and the neighbors would talk about you, or so you thought. These are the types of things that get us to go out and spend money in ways that do not benefit us, purchasing things that are liabilities, losing value fast, instead of purchasing things like assets that are going to appreciate in value and also provide income in many cases. So that brings us to a subject that I've talked about several times before. One of the biggest liabilities out there is the car. The car, they have taken that from point A to point B transportation and basically convinced you that the car you drive is an extension of who you are. And they've connected that to a dopamine hit that you get every time you drive through town or stop at a stoplight. You are, in your mind, exuding who you are through the shape, style, color, year, make, model of this vehicle. All the while, the minute you drove it off the lot, it was losing value sitting there in the lot before you bought it. Now that you're driving it, it's losing value fast, but you're still pumping money into it. Now, we need cars in most of America. I think New York City is really the only place in America that you can get along without a car. A lot of people don't even have driver's licenses. Their public transportation system is so ubiquitous. But for the rest of us, what do we need versus what do we want? A to B transportation is what we need, okay? And as long as it's reliable and well maintained, then it will continue to serve that function. And the longer you keep it, the less expensive it becomes. But do you know that the car vendors are out there, the dealers are out there, giving out up to 84-month loans on cars? 84 months. That's 7 years. Please don't take that bait. A 7-year car loan is actually designed to hurt you, okay? And look, if you're in it for the latest and greatest vehicle, then it's quite conceivable that you'll be driving around in a 7-year-old car still making payments on it, long after you have reached the epiphany of this being a financially unsound prospect. Now, 5 reasons why you should refuse these long-term car loans. Number 1, you're underwater immediately. And we all know underwater means you owe more on the car than it's worth. So ideally, consumers should go for the shortest length auto loan that they can afford. A lot of people don't do that because it pushes up the monthly note on the car. The shorter the loan length, the quicker the equity buildup in your car. So the quicker you get to actually own it, be the outright owner of the car, continue to maintain it, as I said, not make payments on it, take the payment that you were making and now put it in something that is going to appreciate in value and make you money as opposed to losing value. If you have equity in your car, it means you could also trade it or sell it at any time and pocket some cash, okay? Even if you don't own it, if you have some equity in it. But most of the time, you're not going to have any equity in a car because they're continually producing cars, okay? It's not like real estate where there's a finite amount. There are more and more cars on the market every day. So keep that in mind. A car, unless you are a limo driver or someone who does Lyft or Uber on a permanent, long-term basis, someone who drives a tractor trailer, those are the only instances in which a car becomes an asset and the IRS recognizes it as such and allows you to get a tax advantage off of the depreciation of the vehicle. Otherwise, if you just own it, that thing's depreciating and you're taking a hit for it. Number two, it sets up for a negative equity cycle. Say you have to trade in the car before a 72-month loan is paid off, which is entirely possible. Even after giving you credit for the value of the trade-in, you could still owe thousands of dollars. A dealer will find a way to bury those thousands of dollars in the next loan. So all of the money that you still owed is being pushed over. And look, we all know car dealers, they are very adept at, making these deals work. It is your responsibility. Don't blame the car dealer because they did what they're supposed to do. It is your responsibility to look at the fine print, to do the math. Don't get in that car dealer and get so enthusiastic about driving out with something that day that you hurt yourself by not doing your due diligence. Interest rates jump over 60 months. That's the other thing they were talking about. It was saying these long-term 72 to 84-month loan terms usually have higher interest rates. And that's crazy because the longer your loan, the shorter or the smaller the interest rate should be because they're making the money over time. But that's not how these car loans are working out. So consumers pay higher interest rates when they stretch loan lengths over 60 months, according to Edmunds, the folks that look at these issues. Not only that, but Edmunds data show that when consumers agree to a longer loan, they apparently decide to borrow more money, indicating that they are buying a more expensive car. Including extras like warranties or other products, or simply paying more for the same car. When financing with term lengths of 61 to 66 months, the average amount financed was $29,591 and the interest rate was 4.1%, bringing the monthly payment to $512. But when a car buyer agrees to stretch the loan to 67 to 72 months or longer, seeing 84-month loans out there, the average amount financed was $33,238 and the interest rate was 6.6%. That gave the buyer a $556 per month payment. So substantially more than what they would have been paying if they had done it, the former way. You'll be shelling out for repairs and loan payments. A 6 to 7-year-old car will likely have over 75,000 miles on it. A car this old will definitely need new tires, brakes, and other expensive maintenance, let alone unexpected repairs. Look, cars need that. Okay, they're machines. They go through wear and tear, and you have to maintain them. So that's something you're going to run into whether your car is paid for or your car is not paid for. But if it is paid for, then you're not paying for those. There'll come a point where you're not paying for the maintenance of the vehicle on top of the note on the vehicle. Okay, finally, look at all the extra interest you'll pay. Extra interest. Okay, this is just money you're giving to the financial institution. It's nothing that's going to help you. Interest is money down the drain. It isn't even tax deductible because you're buying it as a consumer, not as a business. Remember, this is just a car to, flex in, ride around town in. So take a long, hard look at what extending the loan costs you. Plugging Edmunds averages into an auto loan calculator, which you can do on your own, a person financing $27,615 in a car payment in the total cost of the car at 2.8% for 60 months will pay a total of $2,010 interest. The person who moves up to a $30,000 car financed over 72 months at a rate of 6.4% pays $6,207 in interest. Okay? Again, substantially more. Interest, money that you could have invested, done something else with, and now you can't. It's going into, the pocket of the lending institution. So you got to buy a car. Okay? Again, you don't live in New York City. What can you do? You can refinance a bad loan. Okay? Get into a loan that's structured differently, has a lower interest rate, maybe a lower monthly amount of months that you have to pay on the car. Maybe that will kick your payment up a little, but you'll get out of it sooner. That's one thing you could do the math on and try to figure out. Make a larger down payment. Now, we've talked about that. I don't necessarily think that you should buy a car outright simply because most people can't afford to do that. Okay, there are some so-called financial gurus that tell you to do that, which is going to put you in a position where you're catching the bus for most of your life because cars, the average price of a car today is $45,000 or north of that, especially now in these inflationary times and supply chain disruption times we're dealing in. Now, leasing is an option too, but you got to watch that because leasing can come back to bite you in many ways. Bottom line is you have to do your due diligence. This car thing is one example. I think it's the most egregious example because I hope people aren't out there, financing jewelry, but maybe they are. Forget trying to look smooth and slick to somebody else. I'm a car guy. I love to see, nice cars, beautifully styled and, all of that. I love it. But I'm not going out here and going to mortgage my future. I just can't do it. I get the I get the dopamine. I get the good chemical flush from my brain when I am putting money to work. Okay? I would get a lot of cortisol and feel kind of, apprehensive and stressed out if I went out here and spent a whole bunch of money on a damn car and I knew that at night that was taking money out of my pocket wholesale instead of putting money into my pocket. So even if you are a car person and you want to go out and buy the latest Porsche, there's a right way to do it, okay? And an 84-month car loan probably isn't the right way. Do your due diligence. I'll link to this so that you can study it. Calculate, This is not like the old days when we didn't have all these calculators out there that could, help us to see what we were getting into. And if you are in the market for a car, please don't go in to the car dealer like I did when I got my first car. And I just had to drive out of the dealership that day with it. I don't care what you do. Just make something happen. I got to leave with this car. I was young, stupid, and over-enthusiastic. Now, okay, the last time we bought a car as a family, my wife brought the paperwork home and read it over the course of like a week. Car dealer kept calling, talking about, you coming back in to buy a car? Yeah, at some point, if we're happy with the, terms that you've laid out. Take that emotion out of it, okay? Put that money that is still yours. The money's still yours when you invest it, okay? You don't have to impress anybody. All right, guys, I'll talk to you soon.